All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. Sorry I'm a little late today. I had the smoke alarms going off in my house and some technical difficulties with my camera, but alas, I'm here. Tim Vest is on a 3-week vacation in Asia with his family, so it is just me this week. And I wanted to talk about how investor expectations have changed over the last 12, 24 months, something like that. Um, because raising capital for our business has become it's ever changing environment, right? So what we're going to do is we're going to talk about how some of the conversations have gone over the last 2 years, what the old playbook was of what people were searching for, what people were chasing, and how those expectations have changed now. Hopefully, you can take some of these things, or maybe you're experiencing the same thing in your capital raising experiences. But basically, the old playbook was that you could double somebody's money in 5 years. And that equates to a 20% average annual return. And the IRR works out to somewhere about the same 18 to low 20% range. That was the hook, right? Everybody wanted that. It was pretty easy to deliver. And let's talk about why was it easy to deliver those kind of metrics. We had super cheap debt, right? We had interest rates down in the 3% range. We had rents skyrocketing because of inflation, and we had cap rate compression. And the cap rate compression was the major driver. Hey, good morning, Dennis. The cap rate compression was the major driver in the value increase, right? Because you could leave all the metrics on your property the same. Don't increase the rent. Don't do anything. Just buy a property and hold it for 2 years. And if the cap rate went from a 7% cap rate to a 5.5 or 6% cap rate, you were doubling and tripling people's money with literally doing nothing. So what that caused was a lot of people to rush into the multifamily industry, myself included. I'm not gonna, hide behind that. And I think where a lot of people got caught up or tripped up were their underwriting assumptions that cap rates were going to stay low forever, that debt was going to stay cheap forever, and that rents were going to continue to go up. Obviously you build in some conservatism to your underwriting and you try to predict what could or could not happen. And you have to underwrite with the information that you have available to you today. So we did that. And it works well until it didn't, right? It was it was a frenzy, right? In order to buy deals and to raise money, and money was everywhere. It was very easy to raise capital from a lot of investors because everyone wanted a piece. Everyone wanted to partake in the multifamily industry, and a lot of people still do. By no means am I walking away from this industry. We're doubling down when a lot of people have exited and gone to other asset classes like commercial or self-storage or buying businesses is a hot key button right now with private equity and all that kind of stuff. But yeah, cheap debt, rent growth, and compression. A lot of people got in with the tailwinds of the real estate market, and we saw a massive amount of growth in a very short period of time. People were transacting deals very quickly, even if things were going off the rails, and they were still making money. And that was a beautiful thing for everybody because everybody was happy. But what happened in 2020, what was it? 2022, 2023, 22 or 23. I can't remember exactly if it was June 22 or June 23 is when the Fed started raising rates, and they were doing it at the fastest possible. It's historic rate increases, right? 75 basis points every 6 weeks of increase was absolutely crushing people's deals. Hell, we had one deal under contract during that rate escalation period, and then the lender ended up walking away and saying, "Sorry, we're not going to do this loan anymore." And thankfully we had good banking relationships. We found another loan to do the deal, and we did the value add and refinanced it in a period of 10 months, right? Because we had to. But what broke really is when the rates started to go up and cap rates started to decompress, and um, the value of people's properties were going down, right? It wasn't meeting the expectations that were set in the underwriting of, oh, the rents are always going to go up, and the cap rate's going to stay low. I mean, for general rule of thumb, when you're underwriting these deals, you typically decompress your cap rate by 10 basis points or 0.1% every year you own it, right? So in an ideal world, if you owned it for 10 years and you bought it at a 6 cap, conservative underwriting would say maybe you're going to sell it in 10 years at a 7 cap, right? And that means that the value is going to go down because the capitalization rate on the NOI has gone down. It's made the property less valuable. It's aged. It's going to need capex. It's going to, hopefully, there'll be some market cycles that you have to weather. And that's where people really got stuck. I mean, there's a lot of loans that were originated in 22, 23, 24, even that were 2, 3 year bridge loans, and they're not able to execute on their business plan. And, obviously the big one that everyone's talking about that I'm kind of sick of seeing now at this point was Brandon Turner's deal down in San Antonio with the disrupt equity guys where they couldn't refinance it after their loan was coming due. But my personal take on that situation is that they did everything that they could in order to save that deal. They bought it when they went in. They bought it with a 5 year loan. Brandon moved to the property. He refinanced his personal residence to put money into the property. I mean, it's not like he just walked away from it and said, investing's risky. Sorry, we lost your money. Like, no, he did what he had to do in order to try to save the deal. Ultimately, he fell short, and that happens. So investors were all eating up IRR, IRR, IRR. What's my equity multiple? How quickly can you get me that equity multiple, right? That's why those two things go hand in hand. Because it was easy, right? The market tailwinds were making it so that anybody that bought a property, they could sit on it for a couple of years and turn around and sell it and make money. But that has drastically shifted over the last 2 years. Tim and I, we haven't bought a deal in 2 years. We've been working on stabilizing our portfolio. Oh my God, the smoke alarms are going off again. Hold on.